Welcome inside the studio. This is Sonoma Wealth Advisors and On the Markets. My name is Dano Weir. I'm the marketing director for our firm. I'll be joined by our firm principals in a moment, Daren, Blonski, and Chris Sipes. This week we are talking about what you're seeing here on the screen if you're watching our stream or if you saw in the title of the episode. Unfortunately, this week has boiled down to oil, gold, and conflict. Tensions in the Middle East. We will look at how news of dual missile strikes in Iran and Israel hit the markets and the larger historical context of how those events impact the long-term trajectory of the market. Expectations for gas prices and oil prices in light of the events in the Middle East. But also looking at the market specifically outside of those headlines, do company earnings even matter anymore? Or are we all just playing games with a moving line and numbers? And finally, as the title indicates, gold. Gold is absolutely smoking every index I won't say every, but many of the major indexes this year. Also, why gold might be telling us that tensions could be calming sooner rather than later. Let's start the show now. All right, they are the managing principals of our firm, Sonoma Wealth Advisors, Chris Sipes, CFP, Daren Blonski, CFP. As I mentioned, I'm the marketing director. Here's some fast facts on who we are. Chris, more about the fundamentals, more of a fundamental guy, looking at the fundamentals of a company and looking at some of the history of the markets. And Daren, more of a technical analyst, looking at the price action and the actual, where is the line actually going on the chart. And together, that unique combination makes our show On the Markets. Chris, birthday this week, and I know you made a cake and you tried to get me to come to the party, and I was sadly busy for the Dow Jones's birthday. But providing some historical context for perhaps current events.
Dan, you just put me into sheer panic because I was like, wait, did I miss a birthday? What the heck?
Yes, and Dan, I appreciate you referring to me, I think, as someone who looks at the fundamentals rather than a fundamentalist. Which
Yes,
I do get that a lot.
Not the word to use this week.
Yes, yeah, absolutely. So but sometimes it can be helpful in times like this to revisit what the market has done historically. Now, of course, that doesn't predict the future or infer the future, but if you look back at the history of the U.S. going back to 1900, and this is from Ryan Dietrich at Carson, showing all these major events along the way, and some were, I'm sure, it felt even worse than what feels like is happening today, as bad as it is. And so the market will tend to surprise you, right? Sometimes it does well when all the headlines are awful. Sometimes it does badly when all the headlines are good. So you really can't invest that way. You have to stay invested through the good and the bad. You're getting paid to take risk. There's a reason why, the Dow, as an example, has done better than just leaving your money in a bank account over that time period. You get paid to take that risk. And without that risk, you wouldn't be getting paid extra. So we should be, I guess, in some weird way, appreciative of times where things don't feel so good.
And I just, for some point of clarification for this episode, maybe it's the first time you're checking it out On the Markets. Our approach is to incorporate what's happening nationally, globally, because it does impact the market. But our focus is the market. So we're not here to necessarily comment on what is or isn't happening, but just kind of look at, okay, well, that's the event, and we're market focused, and that's where we'll be today.
Absolutely. So, way back on Wednesday, which is, I guess, old market news at this point, we did get some good news on the consumer price index front. The year-over-year CPI came in at 235, which you can see on the longer term. This is a 10-year chart, kind of getting back to a more normal range. And now, of course, this is, have people that say, well, this isn't the real, measurement of inflation, et cetera. It is not the absolute price value. So if you're like, well, if it's only 2%, then why are eggs, twice what they cost 5 years ago? Well, it's because this is a year over year percentage, right? You see that big inflation pop that we had in 2022. And going into 23, we're starting to kind of get on the other end of that, where we're more towards normal. But also, it's interesting that the Fed is having trouble kind of fighting that last mile, to get us back down to, I guess, under 2%, which is what they have said is their goal. What's so funny is that those that have been following the markets for a long time will probably remember pre-COVID, the Fed was shooting for a 2% inflation rate on the upside. They kept saying, we're going for 2% inflation. They couldn't get it. And then we got COVID and far exceeded that, got into the nine handle on CPI. And now we're above 2%. They're shooting for 2% on the downside. And can't quite get there either. So interesting.
On the upside and the downside, you mean that they were below 2% inflation and they wanted it to be higher?
Correct. Yes.
Why?
Well, there's sort of a Goldilocks situation where you don't want to get deflation. Okay, that's when prices are going down. That's what happened during the Great Depression. You had a credit collapse. That's also what happened in 2008. Credit is the real money in the system. For every, dollar that's kind of moving around in our checking accounts and such, there's probably 10 to 15, maybe $20 of debt. And so when you get in a debt collapse, like we did Great Depression and in 2008, that the value of that debt goes to zero and those prices come down. Or at least gets, that debt gets badly hampered. And so you have things like asset prices falling, and that is a spiral that we do not want to get into either. You want to have a little bit of inflation, but not too much, because people hate inflation as well. It creates a lot of problems when things are getting more expensive too rapidly and the value of your money is losing value quickly. But it also is almost equally as bad and can be in a spiral in the other direction when you get deflation. So they're looking for that Goldilocks scenario of around 2%.
So you're saying my In-N-Out double value meal is never going back under $10. That's what you're saying. That because I was hoping that would. All right, fine.
But hey, you can still get your $1.50 deal at Costco for your hot dog.
Yes. We got one.
That's right. So with crude oil popping, WTI was up something like 7% today. I'm sure Daren's going to go through that in the candlesticks. So we'll actually see, kind of more real time. But that is kind of the big, scary impact of anytime something starts to happen in the Middle East, is that it's going to affect the oil supply, which therefore will pass along to basically everything in the economy that runs on energy and cheap oil. And so I thought it'd be interesting to look at gas prices going back to the early 90s. And I was surprised to see our gas price nationally is about the same place it was in 2007. That's one thing that was very surprising to me looking at this chart. The second thing was that you tend to notice gas prices going up fairly significantly into a recession, which makes sense. The input costs for things all across the economy goes up. It's going to be difficult to make money. It's going to squeeze margins. It's going to most likely create recessions. And recessions are the gray bars that you see here. those energy prices drop a lot in recessions because there's just less demand for that energy. And the third thing that I thought was interesting was that spike that you see in 2022. And I cannot get off the fact, guys, that I feel like 2022 was the recession that was never officially called. When you look at all of these leading economic indicators, when you look at the yield curve, when you look at gas prices, you look at many asset prices from 2022 that saw huge corrections. All the inputs for a recession were there, and yet it was never officially called. And I think you'll remember that we actually had 2 quarters of negative GDP growth, which they also said, yeah, that's technically a recession, but we're not going to call it a recession, right? So just the fact
just for everyone out there, let me interrupt for a sec. So let's talk about it for a sec. How are recessions actually called, Chris?
So there's an organization called the NBER, and they look at the data, the inputs, and everything, and they're the ones who actually call a recession. They're the ones that say it's officially a recession, usually after the fact, not proactively, not even at the beginning of one, but usually after the fact.
Are you telling me that this group is politically influenced in any way, shape, or form?
I honestly have no idea. All I'm saying is that it's been enough time now that I would have thought they would have called a recession. I mean, we saw corrections, major corrections in real estate, in the bond market. We saw the worst bond market since the Civil War. There's definitely been a correction in small caps, which we'll see in a few slides. So we saw a huge market correction. Even the tech stocks, the mighty tech stocks, were down, significantly in 2022. And you have so many charts like this, all the fundamental charts, right, that said, hey, something's off here. Something's off. And yet there was never an official recession called. So call that whatever you would like.
Daren, I feel like you're trying to say something here. I don't know if it's, very thinly veiled or not, but
it's not thinly veiled at all. I just think it's important to point out that, quote unquote, a recession, there is a political layer to it, right? Like, is it completely political? I don't know. But is there a layer of politics involved when it comes to deciding if there's a true recession or not? Yeah, absolutely. And it's very possible that if it's not politically opportunistic, that we would look the other way on calling that recession. And I think to Chris's point, like, we saw this data suggesting that there was perhaps a recession, and yet there was no call of it. Maybe that's conspiratorial. I don't know. But I think it's just important to note that there's no, like, this is the red line, and once it's crossed, we're quote unquote in a recession. It's a group of people in the room who all have different perspectives and different people influencing them that get together and say, yes, this is a recession based upon their review of the data. So I think that's important for people to know, that it's not just like, oh, this indicator says we're in a recession now. And that makes part of the challenge for our business, or for what we do, of helping people understand the markets, is there's no clear cut, because this happened, there is a recession. There's some things that happen that often indicate there is a recession, like the yield curve and slowdown in jobs, but it has to be a whole grouping of different economic data, and it has to be fairly overwhelming for that decision to be made. And it's always made after the fact, right? So when people say we're in a recession, it's usually by the time the recession is quote unquote blessed, it's when that happens, then the market's already moved, and it's already probably going up by then. So it's super important not to pay attention to any of that garbage. It really doesn't matter when it comes to investing.
Yeah, the market tends to start going up, or bottom, I should say, right about halfway through the recession, which we definitely saw, right? I mean, it was, end of 22, if I remember correctly, fall of 22, you started to see recovery in the markets, and it took off again. So I guess it doesn't really matter, Dan. At the end of the day, like, we did see the market correction. I forget what the old saying is, but something like, if you still have your job, there's no recession. But if you lost your job, there's definitely a recession, something like
Right.
that. Or your neighbor loses their job, no recession. You lose your job, it's a recession, right? So
I don't want to go too
anyway.
long on this point, but I'll just say I do think there's this old idea, and I don't know why we still have it. None of us were alive when this happened, but it feels like there's a guy in like a 1930s radio voice who's just going to come out of a stone building and go, "It's determined, it's a recession," and then like all of a sudden we're all in bread lines or something like that. That's what's like in our minds because of history books. But what we do on this show, what we do at our firm, there's a lot of self-reliance and a lot of look at it yourself. Does it really matter what a headline says? We see this, 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 and this. Therefore, we're going to do this, 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 and this. So just kind of our approach.
Yeah, absolutely. Now, this week we got the sentiment indicators, and it looks like we are back to normal. Of course, this sentiment survey comes out on Thursday, so this is attacks in the Middle East. And so we are back to normal levels on bullishness, neutralness, and bearishness on the AAII survey. The CNN Fear and Greed Index is basically unchanged at 61 greed this week. And then Bitcoin was at 61 greed, which was up from 45 fear last week. So kind of back to more normal readings in all the sentiment indicators for this week. Now, it's interesting, and I think you want to look at where the consensus is when you're trying to figure out, where might the risk be concentrated. And this is interesting for Mo Hussein, saying that the aggregate financial asset allocation across households, mutual funds, pension funds, and foreign investors is at an all-time high in equities, which is stocks. It is definitely, from my point of view, anecdotally, people definitely feel safe in stocks, and that is, an interesting thing given their historic volatility. But it's the I think part of the market where, the parts of the market that have done so well are household names, companies that we all interact with daily and feel comfortable putting more money into them. And so it's been this market narrative that has really, self-reinforced because more money goes into those names, they do better. People continue to feel safer there, and so we're at all-time highs in the equity allocations. That makes me a little nervous. Now, cash is also near lows, and so is debt, which would be bonds. We've been lower in bonds previously, so it's not an extreme yet. But I think the fact that bonds did so absolutely horribly over the last 3 or 4 years, again, the worst market since the Civil War. People just really feel like, hey, stocks are the only place to be. U.S. stocks are the only place to be. And I know these companies. I feel good about their future, and I'm just dumping my money in there.
I'm going to get a special bell that I'm going to ring, and I'll only ring it when Chris mentions the Civil War on the markets. And you would think that I would never ring that bell. But in fact, there are several episodes where we throw it way back to the 18 whatevers.
Yeah, that's right. That's right, Dan. And this chart only goes back to 2006, so not all that far.
Come on.
But what you can see here is the forward price to earnings multiple. So based on forward earnings estimates for the S&P, we're at 22 times, which you can see relative to history. And if this chart did go back further, this would be very high. And so people are pricing stocks for a very, very rosy outcome. And you see back in 2009, we got down to 9 times forward earnings. That's the trough in this chart. And really, if you just threw spaghetti against the wall with the S&P 500 or any, almost any stock at that time, people hated them so much after going through the 2008 crash that you could buy them dirt cheap, and they've performed extremely well since then. Some pullbacks, obviously, here and there, but we've never really even got back down to that, 14 times 15 times. I guess we've visited a couple times where we were prior to 2008, but nonetheless, stocks are not cheap. They continue to price in a very, very good outcome moving forward, and really no downside priced in at the stocks at these levels. So this is from Goldman, JP Morgan, by way of Mike Siccardi, saying that JP Morgan says U.S. small caps already had a recession. So small caps would be small companies inside the United States. There's several charts here showing that. Now they're not referring to 2022; they're referring to now, basically, in this chart. But I would say 2022, that fall from the 21 high, seems to me to be a marker. Now the bottom right chart shows the peak to trough move in the S&P 600 versus the S&P 500, and the current move that we're seeing is at 36%. I know those numbers are pretty hard to read. The average has been 31, so we're a little bit above average in terms of how much the small companies have underperformed the big companies. On this chart, there was only a couple other times that happened. That was in the 80s and from 83 to 90, and then in 94 to 99. So there was a 5-year span there as well, where we got as much as 50% between those two. So again, it really just matters location in terms of where you're invested, and if those stocks have already experienced a recession or not. And here we can see a chart of the Russell 2000. Not investment advice, of course, but this is just one of the ETFs that tracks the Russell 2000, so that you can see we're still, this is from 2021. This would be June 13th of 21, so 4 years ago. We're still down almost 10% off the highs from 4 years ago. So it's been a 4-year walk in the desert for small caps. And who knows how long this will last? Hopefully not much longer for those that are invested in this area, because historically, small caps have done better than large caps, which would make sense given that you are taking on more risk. It should be easier to grow a small company than a large company. And for a lot of them, there's somewhat of an illiquidity premium. You can't dump as much money into them. So if you're like a huge institution. So small caps really continue to struggle, showing all the signs of a recession that have already happened in small caps.
I feel like I'm looking at an international stocks chart like 2 years ago, Chris, where it looks hopeless and looks like it'll never get back, and there's nothing that will ever turn this around.
Yeah, I mean, really, if you looked at almost any chart outside of the Mag 7, of course, it would look pretty similar to this. The Mag 7 being really the only area of the market that was able to hold up and recover and has pulled the rest of the S&P 500 higher.
Right, but what I'm saying is similar to international. International was this dog forever, and then now this year, boom, completely
Right.
turns around, and you will look at these valleys and go, man, I should have been in. That's not investment advice, but I'm saying that's when you look at things like that and you see how down it is. That's a way to look at it as an opportunity.
I can say that a lot of clients are asking, why do I even own these at this point? Similar to what we were hearing regarding foreign stocks, right? So you can't know the future. And usually when everybody's asking, why do I even own this? Usually the light is you're getting close to the end of the tunnel, right? And it's hopefully not a train coming at you. It's a lot harder to fall, get hurt falling out of a first story window than the 15th or 20th floor, right? And I think that's important too, is like, what's the downside, right? These things have already been wiped out. Nobody thinks they're going to do well. Sentiment is just awful. And yes, I'm talking about small caps, but I could be talking about bonds too, which is what we're looking at here. And you've got interest rates and inflation from JP Morgan, and the blue line is nominal, what they call nominal yields. So not taking into account inflation. And then you've got the gray line, which is real yields. And so that's the excess coupon that you're receiving on tips over the inflation rate. And so you can see we're just kind of getting back to somewhat of a normal situation, but we were so low. The rates were at, multi-decade lows coming into this. And so it was a painful ride going up, because when rates go up, bond prices go down. But now we've got a pretty healthy real yield getting close to the average from 1958 at 192. We're at 163 at the end of May. And we've got nominal yields also getting closer at 441 versus 573 on average. Now that average is really deceptive, because you look at like the 70s and the rates were all over the place. So that was a whole decade where rates were anything but normal. But I would say the rates coming out of the 09 recession were also similarly anything but normal. And maybe some of the assets and asset classes that did so well coming out of the great financial crisis and in a super low interest rate environment, that environment seems to have changed at this point. And maybe moving forward, we're not going to see that same ultra low interest rate environment over the next 10 years. So here we've got year-to-date bond yields. I think this is interesting given all the stress that we've seen in the market. This is the total return of the 7 to 10 year Treasury in purple, and then you've got the long-term Treasuries represented by the popular ETF TLT. Again, this is not advice, but just to represent what's happening here. We've got returns that are positive, which is great, but not what you've seen in prior super stressful geopolitical times. And if there's anything you could say about the last 6 months, we've had a lot of things going on around the world. And for the first time, really, the dollar is not responding to that in a positive way. People are not flooding money into the U.S., and therefore our rates are not going down. If anything, they've been kind of staying flat to elevating, which may be signaling some sort of regime change globally in the financial system, of just fewer people rushing into the U.S. Here we've got the spread between short-term Treasuries and 10-year Treasuries, a common recession indicator. At least it had been until this one. We inverted way back in, I want to say it was 22. I remember it was April Fool's Day. I can't remember if it was 22 or 23. We stayed inverted until just towards the end of last year. We disinverted, if that's a word. We got above zero, which is more of a normalization of the yield curve. You should get paid more to lend your money out for a longer period of time. When you're not, that's not a normal situation. And we just went through the longest abnormal situation in the bond market and in the rates market, at least according to this chart. Every time previously we've got an inversion and then disinversion, we have seen a recession just around the corner right after the disinversion happens. It's yet to be seen if that's what's going to happen here. But nonetheless, it's interesting that the market really sees around corners. And like Daren always says, you never know what the actual event is going to be, but it only makes sense in hindsight. But a lot of times the market has seen these things around the corner.
And Chris, I have to apologize, because not only did I not make it to your Dow Jones birthday bash, but I also missed your disinversion disco party that you tried to throw in January. I'm sure it was a great time. I've got kids and it was really difficult to get to, but I just want to let you know that when it reinverts and you throw yet another party, I will go to that one.
You're always invited, Dano.
Thank you.
Now, speaking of seeing around corners, gold here represented by GLD, the popular ETF. This is just year to date, which is unbelievable, right? We've got gold up, and this is as of yesterday, I believe. So we're probably north of 30% after today's close. Closed at another all-time high. Gold, and this is comparing it to the U.S. stock market as represented by the S&P 500, which is going to be your larger companies, your mid-cap, which is the green, and then the small caps, again, lagging, struggling this year. Gold has just been on a tear really for several years now. And you keep looking at it and going, gosh, what is gold seeing? What is gold seeing? Well, it could be inflation. It could be geopolitical issues. There's things you want to have in your portfolio if you're concerned about inflation, but you want to think about what causes that inflation. Like if it's a cyclical inflation, tips are probably going to do a pretty good job of taking care of you there. If it's just a normal cyclical inflation, if it's a inflation driven by growth, we're building a lot of things and the economy is booming, then commodities are typically going to do really well. But if it's an inflation driven by debasement, that's where gold really shines. And at least so far, the market seems to be saying this particular moment for gold is driven by debasement.
All right, great. Gold's up, so just go buy a bunch of gold. That's what you're saying?
Of course not, Dan. Moderation, right? Everything in moderation.
That would be a natural thought when someone sees a chart like this. So for someone who would have that natural thought, as Daren often says to me, our brains are wired to do it wrong. Why is that perhaps not a good idea?
Well, first off, it's an asset class that kind of attracts almost a religious level following to it, right? So if people are into gold, they have the inclination to just put everything in there, right? And I don't think that that's a good idea about any asset class. We just talked about people piling into U.S. stocks, large cap stocks, a handful of U.S. large cap stocks. I don't think that's a good idea for the same reason, which is you can't know what will happen in the future. A lot of times when it feels the best to be jumping into something, it's the exact opposite because we're wired to herd, right? And move with everybody else so that it feels like consensus. But in investing, by the time it's consensus, it's usually over. And so you want to really fight that urge to go where everybody else is going because you're probably paying a lot higher price, which is, again, falling out of that 15 or 20 story window instead of the first floor.
So again, not investment advice, who knows the future, but if we're going by some basic investing principles, this chart would not be an opportunity, and this chart might be an opportunity.
They could both be, right? Because you have momentum.
You never know. You never know. This one looks absolutely horrific, and you would never walk into this.
You're looking at the potential upside versus the potential downside.
Right.
And when something's already up a lot and just, the S&P, the gold's done better than the S&P over, 20 some years. There's maybe less potential upside than something that's just been left for dead.
Right. That's all I wanted to say. We are moving to the second half of our show. So Chris with the fundamentals, looking at some of the economic indicators. Daren, the technicals, the technical analyst. And I have to even step aside and give him full power to present the whole show himself. This is where he takes over. We don't know what he's going to do. He's starting with a map. And Daren Blonski, what do you got?
Dano, it's always a great mystery what I'm going to talk about. You know that.
Bitcoin. End of sentence.
I'm actually not going to talk about Bitcoin. I can if you want to, but I always have something to say there. But today I'm going to talk about a map. And I thought we'd start by just kind of showing some geography, right? And why is geography important, especially in this moment in history? And the reason is because oil comes from this area of the world, and to a large degree, and in particular in California, we are highly dependent on foreign oil sources. I don't know if you guys knew this, but California gets very little of its oil from the United States. So what does that mean? Like, why do we care? Well, us Californians are always complaining because our gas prices are so high. So the dependence on foreign oil for Californians is pretty high, which means what's going on geopolitically right now will impact us in California more than perhaps other parts of the country that are less reliant. So let me orient everyone for a minute. So this is Iraq. This is Iran. This little area here is Israel. So Israel is quite a bit smaller than Iran, and what happened? So I guess yesterday evening or the evening before, Israel went in and started launching bombs and whatnot on Iran with the claim that Iran had obtained nuclear weapons and they were going to use them, and so Israel had to strike first. That has then since led to Iran retaliating, and as of earlier today, sent quite a few ballistic missiles into Israel. More are expected. So,
and just to give some scale here, I just looked this up. Distance between Israel and Tehran, this would be the equivalent to like San Francisco to Denver.
Well, and therein lies in part of the issue, right? Because what's kept, I think, Israel and Iran from going head to head on things for a while is the distance between them. But what Iran has done is it's created proxies. Yemen, which has been in the news quite a bit because of this little area down here where a lot of the world's goods and oil, etc., come through this area. And Yemen was lobbing bombs and hitting different ships going through this area. Well, Iran had created a proxy out of Yemen, a group down there, and they were making it pretty difficult to move ships up through the Red Sea. In addition, Iran also controls the Strait of Hormuz, and this is really what I wanted to point out. So this little piece here of sea, this is very, very important for the world and for the value of oil and what oil costs per barrel. And there's a lot of thoughts that Iran is going to shut this part or this area of the Strait of Hormuz down. Why can they shut it down? Because just the geographical makeup of this area, anything going through there is fairly easy to target for them. Well, if they shut down that area and oil can't move out of the Persian Gulf, the Qatar, Bahrain, Kuwait, Iraq can't ship all their oil out, that becomes very problematic for all of those economies. United Emirates, and then would create a lot of turmoil in the Middle East, probably also make Saudi Arabia very unhappy. So Iran, while they would love to shut this area down, if they start blocking all these areas from shipping oil out, not is that just problematic to the United States, but it's problematic to China. And China is a pretty important ally because it's one of the only allies Iran has left. So they don't want to alienate them too much. And then we've got down here in Yemen, where the Yemenis groups down here are targeting the Red Sea ships. So really pretty quickly, you could shut down a lot of oil going on and moving throughout the world. Why? Then one might ask, well, why is oil up since this battle begun? Well, here we go. So you can see oil has moved up considerably when Israel started bombing Iran. We were down at 60. We've been talking about oil and the potentiality of a recession for quite a while. Now, here's what's interesting about this. If oil goes up exponentially and our gas goes up and everything we buy that is produced with oil, that becomes problematic for the economy. I just find it interesting. And I told Chris and Dan earlier this week, sometimes I just feel like I'm living in the Truman Show, because it would be particularly interesting that the yield curve just reinverted, which we're at the highest risk for a recession when that happens, and magically oil goes up because there's this fight that breaks out in the Middle East that's been building for a very long time, that then pushes up prices enough that decreases demand just enough to tip us over to find ourselves in a recession. On top of that, we've already got really weak job numbers. I don't know if Chris and Dan, you caught that this week, but all these job numbers have come out from, the government people who calculate these things, and they come out with these job numbers, and then quietly they kind of redo it the next month. And
wasn't it down like 219,000? Oh, we were off by like 200,000. Wasn't that it?
Significantly. So the jobs numbers are very noisy, right? So the market kind of says, oh, the unemployment rate's this or that. But quite often those job numbers are not correct. So I always just find it interesting that the market moves off those numbers, but yet they're always recalculated the month later and then usually lowered. And so what we found is that really we haven't added much of any jobs this year. And that's obviously problematic. Another, check on the side of the recession world, right? So when we look at oil, now oil's spiking and you can see in the chart going up. It's interesting that it's going up right now, right? In a way, it could be that, that needle that breaks the camel's back, or that, that final straw that pushes us into a recession, which would make sense given everything going on. Does that mean the stock market's going to go down? No, it doesn't mean the stock market's going to do it. So don't take that and start trading and whatever on that. It's just the reality is we might be facing that. Now, Dan, you kind of teased when we started off and said, you said something to the tune of oil might be telling us that this might be over sooner than later. And here's why I'm saying that. So if you look at oil, so the market is in a way saying, we don't know that we believe that this whole event going on in the Middle East is going to be sustained. If we put a trend line on oil here, you can see oil traded up above that resistance point on a trend line today, and then quickly sold back off. And a lot of times when that happens, that's happening because that's the market trading the price up. So at some point, oil went up to $77 a barrel and then came back down and closed the day at $72 a barrel. And that's a pretty big spread, pretty big move. But the fact that it settled right back down, I think is interesting, right? I don't know for sure that in fact that it's going to settle down or anything like that. It's looking pretty shaky right now with Iran now taking direct hits on Tel Aviv and literally flying ballistic missiles into apartment buildings, etc. What is also interesting when we look at chart patterns, so going to your point, Chris, or Dan earlier about technical patterns. So this is a triple bottom right here. And so this triple bottom is usually a bottoming type formation on a chart pattern. What's interesting though, and this is the other why I'm like, maybe it's getting close. It's really not going to get that crazy. And here's why, because we have that triple bottom. And then when you have a break of a triple bottom, it tends to move between what we call the neckline, which is ultimately right here. And then the extension off the neckline is about the distance of that depth of that, what we would call inverse head and shoulders is another way to call it. And you can see that distance line up 13%. And that's kind of about in range where we ended up today, right in here. Which I find interesting from a chart perspective. Like, it just amazes me how often these charts kind of tell the story. We don't really know what it is that will be the catalyst to tell a story. But had you looked at this and said, okay, this is an inverse head and shoulders, and given we have a break of an inverse head and shoulders, we're likely to have an event somewhere around here, and it's probably going to extend, some degree, about 13% up from that inverse. And you stack that puppy right there, and lo and behold, magically, we have completed that chart pattern. Again, that's why I said to Chris and Dan, man, it feels like I'm in the Truman Show sometimes. Right on time. And it's just interesting how the market works that way. And so yes, oil's going up, but it seems to be in line with trends. If we break above and hold above 76 next week, then I think we're in a different story. And I think this trend is now broken, this downtrend. I think we're on an uptrend. If it holds above 76, then I think we got bigger problems. I think that's going to lead to a recession. Then what will happen, price in oil, when it shoots up, then it tends to really collapse because then people just stop consuming. So let's go to the S&P 500. So for those who don't join us on a regular basis, this is the S&P 500 when you look at it on a from a heat map standpoint. I like the heat map because it just kind of gives me a visualization of what happened in the market. So each one of these squares is the relative capitalization to the other squares in the S&P 500, which is the largest 500 US-based stocks. Microsoft, Nvidia, Apple, Amazon, Tesla. These stocks have really driven the market higher. But really a lot of red on the screen today. The only green is really the energy sector. Why? Because, well, stocks and energy are going up because there's perceived to be, at least at this point, that there's going to be a constraint in supply because the Red Sea, Strait of Hormuz, those areas are going to be more difficult for ships to navigate and get oil out of there. I don't think it'll last very long. I do not think that all the countries that are sitting around the Persian Gulf are going to tolerate from Iran too much more of this because it really gets in the way of their ability to produce. I also don't think Iran's going to keep it going too much longer because China is going to get very impatient if their oil stops moving into their economy. China is already in a struggling position. So I think Iran has to kind of thread a fine needle here. Now, I do believe that Israel and Iran think that they're in a fight for survival, which could escalate, and that's the scary part. Whether Iran actually has a nuke and we just don't know it, or people who know it just haven't shared it, and perhaps we know Israel has a nuke. And if too many more ballistic missiles land in Israel and it gets too bad, I don't know why they wouldn't deploy a nuke. So that becomes problematic too. And you can understand why, though, because they, in truth, believe they're in a fight for survival. Right, wrong, or indifferent, that's what's believed. So now when we look at the S&P, though, which is interesting, and I don't know if you, Dan or Chris, remember this last week, but I talked about how we were likely to get a breakout and a retest of this area. Because when the stocks break out, they tend to come back in and they resume higher. I think it's fascinating. Again, so this area is real. This which was support is now support, which was resistance when the market came back up above this area, and this is just where buyers and sellers were sitting. It broke above that and it came back in. It tested it and held. And it actually closed the day holding. So I actually look at this and look at the stock market. I'm actually constructive on the stock market. Shocker, right? I think all we really saw from a technical standpoint today was a test of, call it 59. The only thing I don't like about this is I would have liked to see a close on the weekly above 600. That would have made me feel a little bit more comfortable here. But you can see this is a weekly chart, and we're up in this range. We're literally in the all-time high range right now on the S&P 500. We're not far. It wouldn't take much to break above that. And the fact that we did hold above that support line, I'm actually fairly constructive on it, even given all the war and garbage going on around the world right now.
Can I ask for a definition or some? I think I understand finally support and resistance, because you're saying resistance became support. And so I think what you're saying here is that, what's that top line, 597? Is that what that is? That support line now?
Yeah, so that green line, give or take 597, is, I put that in the chart, right? So I put that in the chart. And so when you look at a chart, what you do is you say, okay, well, let's look at this chart and use charts to figure out where all the buyers and sellers are psychologically hanging out, right? Because there's thousands of people around the world, millions of people looking at these charts. And so if you're looking at this chart and analyzing it, what you would do is you say, well, this is interesting. Okay, so if last week the market was here and say, wow, this area is really important. You can see it was support right there. It was support right there. It was support here. It was support here. It was resistance right there. I think that's a pretty important psychological point where buyers and sellers hang out. So what I'm going to do is I'm going to just go ahead and I'm going to put in a support line, somewhere right around here, and so we go like this, and there's our support line. So we know something in that range is a really important point where buyers actually are willing to say, no, I like it at that price. I'm going to step in. That's support. And then sellers or resistance is where sellers say, well, right here, you can see today, that was resistance. That's where the sellers said, I don't like that price. I think it's getting overbought. I'm going to sell today. And so that was this week where the market moved in between these points. The fact that it broke above there, held this support area that it broke above last week, that tells you like there's support here. There's a lot of people willing to say, I'll take a bite of the apple right here because I think that it's going higher.
But psychologically, if we were to look at October 2024, 597 to a buyer in October 2024 would have been like, man, that's way up there. That's just like, can it even get there? But then flash forward to the next few months, not only does it get there, it's like, oh yeah, no, this is the price now. No, we're just hovering around here now. Now can we go even higher than this? We might dip a little bit. We're always coming back to this. Psychologically and really simply, is that kind of what you're saying about support and resistance?
Yeah, they become anchor points, right? They become psychological anchors, right? Where people are like, no, that makes sense, right? And you see that, just think about it from a basic economic principle, right? It's like, the more someone buys a product or sells a product at a certain price, that becomes a more like accepted price for that, right? You see it in like real estate, for example, right? Like if you think that the average house is, I think it's like $450,000 is what the average single family residence is in the United States, somewhere in that ballpark. And you go back to our parents' generation where, in their first house, they bought the house for 20 grand or something like that. And like that, the idea that they'd even be buying a house for 400 grand would be just psychologically crushing to them. Whereas like now we're like, yeah, well, that's kind of reality. If you want a house, that's what you got to pay for it. Right. And so over time, our minds adjust and become more used to a certain price point. And that's why we say when we're looking at charts, what happens over time is the more often that a chart visits a period or an area on the chart, the price actually hits that area, the weaker that area becomes. And what that means is that more people are willing to take a bite of the apple along the way at that price point. And the more people are willing to take a bite of the apple at that price point, then eventually it moves higher. The same is true, right? When we, you can see this better on the SPX. This is S&P 500, but it's traded a little differently in broader hours. So this was the all-time high back here in 2022. And then the market moved down, it went back, it went up, and it never really revisited and tested that point. And then just recently, when we had our tariff tantrum happen, we had a test of that area right there. And on that day when it tests, I remember I was talking to a client and I was like, this is bottom, I think. It's more likely this is the probable bottom at this point, because this psychological area was tested. But now say, for example, and if you've been following us over the last few weeks, had the market gone up and then, and I think if you go back a couple weeks and look at it, but if it had gone up and then revisited this point, I would have been much more concerned about this point. If it revisits it multiple times, then more likely to break through. The probabilities of breakthrough become higher. So last week I said, hey, I think we're probably going to see all-time highs. And the reason I'm saying that is because you have this part of the chart visited once, visited twice, and now we're knocking on the ceiling of it again. And we revisit it a couple times, so eventually people's brain gets used to that price for the S&P and it breaks above. Same thing happening in gold, right? Here's the gold chart. And gold currently, if it were to close out this month on it, would close out an all-time high. It never closed a month or a week above. Actually, technically, we closed the week at the all-time high for gold. It's never closed. It's gone higher, but it's never closed a week. And you can see this trend line, right, that was happening. We'll look at the daily. So this trend line right here was happening, and you can see it visited, went down, and then it visits it again, went down a little bit, and then boom, breaks through, and then it breaks through, and then what do you see? You see that test. Now this line becomes support, off to the races. So if you knew nothing about what was going on with Iran and Israel, nothing about any of that, you could literally just look at the price of this chart and say, oh, look at this. We had a trend line down. It tapped it here, was rejected. Tapped it here, is rejected. 3 times visit, gets rejected. That maybe, I don't know. But then all of a sudden you start seeing support, people buying, breakthrough. You see that and you say, okay, it broke through, but it might still be a false breakout. I'm going to wait to see if this trend line holds before I buy. And then you see, okay, well, the trend line, it came in here. It held, meaning a lot of buyers stepped in right here. And then boom, it goes up. We take all-time highs on gold. That's how traders think, right? That's called swing trading. Not so much day trading, but swing trading. You're just trading chart patterns. But there's a perfect setup. And that's what I'm saying. There's kind of that setup here in the S&P, right? We had our breakout. We had our retest. So you could argue the fact that we closed out a weekly chart right there. We're going to take on all-time new highs now, which I know seems ludicrous for me to be saying right now, given everything going on in the world. But we're literally staring down the pipe of a potential World War III. And I'm like, hey, all-time highs. And the market doesn't care. And that's what I try to tell people over and over. All this political BS, all this stuff going on. Yes, there are moments where it freaks out, but the market is on a mission. And if you learn to read what the mission the market is on, all the junk and all that fundamental, no offense, Chris, data just becomes noise. All right. I think I'm going to leave it there for now. I don't think there's much else to say about the market this week. Our thoughts and prayers are with all the people in Israel, in Iran. Awful situation for both sides. And hope cooler heads prevail and that calms down before it gets worse.
All right. Thanks for checking out our show. Well, we are Sonoma Wealth Advisors. You can find us at sonomawealth.com. Wherever you're listening or wherever you're watching, make sure you subscribe. And thanks so much for checking out On the Markets. We'll see you next week.